Hello everyone, my name is Samir and I'm the co-founder and the CEO of Juni. We are the best banking solution for e-commerce companies. And one of the subjects our customers ask us a lot about is how to raise capital. So that's what I'm going to talk about today. And raising capital is a broad subject and we'll go through different parts of it. So just starting off directly, what I'm going to talk about is essentially these four things. So a little bit about me and the reason I can talk about this subject, Juni, what we do, the framework on how to raise capital, and then some last tactic advice. So let's get going. So about me, before I've founded Juni, I've done some different things. My main experience is that I've had two e-commerce companies. One of those companies was a failure, and we did pretty much everything wrong, including raising capital the wrong way. And the second company was more of a lifestyle success. And based upon my experiences in those companies, I was the one responsible for managing the financial management. I created Juni together with my co-founders. And we did that because we had a big frustration with the current solutions out there, the different banking solutions and financial support systems for e-commerce entrepreneurs like all of you. So besides that, I've also been a venture partner for US VC and I've been COO for another fintech in Sweden. Okay, that's a little bit about me. Coming into Juni, for you guys who doesn't know so much about us, what we are is the only banking solution in the world tailored for e-commerce. We want to be your financial companion, your advisor that helps you build a great company without having to worry every day about your financials. So it's pretty simple. When I talk about how to raise capital, you have to look at yourself first. So we have raised over 20 million euros in the last year. And we started out with our seed round in Q4 2020 and then our Series A in Q2. So that was just a couple of months ago, actually in June, and we raised 18 million. We have some of the strongest fintech and e-com investors backing us. So Share Ventures, Philly Capital, partners of DSD Global, and great angels. So we've chosen the right partners for us to be able to help you as an e-commerce to really win. And one way we're doing that is we have a program called Juni Connect. So Juni Connect is very easy. We know that a lot of you want to understand better how to come in contact with investors so you can get the capital you need to ramp up. So we have a networking program where we help you put together the data and the decks, and then we connect you and intro you to the best e-com investors across the globe. And some of the ones are the same that invest in us, so Felix, Cherry, but also Lightspeed and others. So if you're a customer at Juni and you're interested, please connect with me after the presentation. Okay, let's talk about the framework. So what is raising capital? So raising capital is essentially about building your company for a liquidity event. And a liquidity event can be different things. One thing is to raise capital in order to actually be able to grow more. But a lot of you guys have a great brand, you put a lot of hours, maybe you feel that you've come to the actual top where you can take it and you want to exit. And that's another kind of liquidity event. And in reality, it's not so big of a difference between the first way of doing it, raising capital, and the second, which is exiting. You could also look at it if you want to take a loan or so on. So all of this encompasses in the same framework. So what's the important things? One thing, obviously, is to have great numbers. But I'm not going to put these 20 minutes on going through how you should think about your numbers, what is a good CAC, what's the growth curve, and so on and so on. I want to keep this around the essentials, the foundation. So if you want to raise capital or exit, you need to play by the rules. And there's 5 pillars. So we have the founder, the market, the product, team, and traction. Going through them one by one. So before that, The first rule, it's all about translation. I think one of the biggest mistakes I see founders do is that they have a lot of knowledge, they have a lot of numbers, they have a lot of structures, but they are not visible for the ones that are either going to give them the capital they raise or the buyers that want to acquire their operation. So what you need to do, if you want to raise capital in a smarter way, you need to translate your reality so other people can see it easily. So that is what it's all about. Giving people the opportunity to understand your business. Second rule, focus is maximizing output. In this case, either raising as much capital as possible for the best valuation possible with the best partners, or if you're doing an exit, the same thing, but just for a one-time period. And I think that is important. If your goal is not to maximize output, obviously all of these rules we're going to go through today is not as important. One thing I see a lot, people doesn't understand the incentives. So it's very important when you're dealing with potential buyers, regardless if it's Thrasios, SellerX, or a VC that you're going to raise from, you need to understand their incentives. Why are they buying your company? Why are they wanting to invest in it? So don't go in blind, and don't underestimate the value of educating yourself in their agenda. Okay. So before you do any of this, think it through. It's a big cost. To do things right is always something that takes time and money. And that means that if you're creating your e-commerce in order to just have a, okay life, to be able to sell the products you love, to, have a lot of time to do other things, maybe you shouldn't structure your company so you can raise maximum amount of money, or it will be easiest to sell to someone else. So think it through. What's your goal with your company? Okay, it starts with you. So the first part of the framework is the founder. So in any great company, you have some specific traits that the founders and the leadership in that company encompass. So you have the domain expertise. Okay, if you are a skincare e-commerce, obviously the best thing would be if you understand skincare a lot. So that is super important. I would say it's two kinds of e-commerce companies. Those who are very focused on the product and those who are very focused on the distribution. And you can either be one of that. But if you don't know your products very well and have a greater understanding of the product and the customer, or what the customer demands for that product, or you're really good at the distribution, then it would be very hard to see you as a perfect fit as a founder. If in any way there is a technical part of your products, that's also something very important. Passion. People want to invest in other people who are passionate. You want to be part of someone else's journey, and you want that person to feel for it more than just money. Very important. Company builder. So if you want to raise money in order to actually, go to the next level with e-commerce, if you are on the other side of that conversation and you are the guy or the girl with money and you want to invest, you obviously are more open to invest if you know that the person have done it before. So that is super important. Experience as a company builder. Okay, not everyone has built a successful e-commerce. So how do you do that? Okay, one of the ways you can do that is also to have people in your leadership or yourself have been working for a great e-commerce before. So if you can't have first-hand experience, you can at least have second-hand experience. Commitment. Commitment is super important. So commitment is all about your time. Nothing else matters. You can't have your business as a side hustle. You can't tell someone, oh, I'm doing this, but I'm also doing these 3 other things. Everyone wants to invest in someone who put all of their time into that, passionate business they love. So commitment, super important. I see a lot of founders building a great e-commerce with great products, failing on, the commitment piece. Okay, next part, the market size. So I'm not going to go into the details how to look at your potential TAM or the total addressable market, but it's very important that you understand your market. So who are you selling to? How many people are interested in these products? If you are a brand selling products in one niche, how big is that niche? And then you need to divide it from bottom up, from the countries you're serving today with the demographics, to the countries you could serve in the future, and how big of a market it can be in the end. Because you need to show the buyer or the VC what is the potential outcome if they would invest, and 10 to 20 years later you have become really successful. If there isn't a big potential market, regardless how good you are, it will not make any great money. Okay, why is what you sell valuable, and what are you actually selling? I think this is super important, especially for very niche brand focused e-commerces. You have, I would say there is those e-commerces that have a product from the beginning, and they sell it regardless of what, and try to find distribution channels for it. Or you try to develop the need. You have a need, there is a pain point, or maybe an ice cream, so something you really want as a user or customer, but you develop it together with the customers. That means that you're asking them, inquiring. So, okay, what do you really want? Okay, oh, you're interested in a hoodie. Okay, but what's the best hoodie? And if you can show either a VC or an investor or and someone who wants to acquire your company, that in your company you don't only understand the basics about the product, but you actually have a framework, a process to talk with the customers. You develop the product over time, so you always keep pace with the need and create something better. That is obviously very important and very valuable. Okay, one thing I'm talking with the customers a lot about is how big is the problem, or what we call the ice cream, so the top on the best thing on top, but also the frequency. Like selling cars, you don't buy a car so often, while other products you may buy every week. So it's important to understand the lead times between buys for your product. Okay, what happens if you die? A lot of e-commerces start out, at least very few people, and even if you are a big one and you have a lot of revenue, we have customers that have super high revenue, still are 40 people. And if you are 40 people, it's very important that not everything is based upon you, especially if you want to exit, because if you want to exit, you may not want to be involved in the day-to-day operations always. So you need to have a strong culture. You need to have made all the knowledge, and I think this is super important, the knowledge of how to run the business should be codified, so a new person can get up and running in the business very quickly. And obviously commitment. You see the golden handcuffs here. That means that the most important people and partners, actually, because a lot of you guys have a lot of outsourced partners, everything from different warehouses to media buying to a lot more. So you want to have these agreements bulletproof. So not all your employees can just leave you directly, because no one wants to invest in a business where it feels like the whole team can go after one day. Last thing on that, I think it's super important that commitment should not be a threat only. You should create an environment where the best people getting a lot of positive incentives of being part of your company. Okay, next one, traction. So just want to go in very high level on this. As I said, we're not going to go through your AOV or something like that. I think that demands a much longer and more deep dive course just about how to think about the KPIs for an e-commerce. But I think what's really important when you're looking at exit or investing is that speed is more important. Speed is more important than where you are right now. So you need to think of it on a long term. So for me, that means that you want to see that in your startup today. So in your e-commerce, okay, if you are able to keep the speed, where will you be on the leaderboard in the next quarter, 2 quarters, 3 quarters. And that's much more important than where you are today. So think of that, and think of that also when you see your actual traction, because you want to show the investor, regardless of if it's an investment now or an exit, that the future is bright. No one invests in the here and now. Everyone invests in the future. Okay, so going forward, this is just a long text. I think it's interesting that when people talk about what is a good investment, it can sound a lot. But in essence, if you follow these framework I laid out right now, I think you will be top 5% most interesting companies, as long as obviously you also have a good product, you see numbers that is interesting, and you have a growth trajectory that will push you in a good position. But I would say the most common situation is the opposite, which is that you have all of that, but you're not able to sell your company or raise money because you are failing on the basics. So think of the basics. This slide deck will be available for everyone afterwards. So you're very welcome to go through and also send me questions, but basics are important. Okay, tactics. I will run through this pretty quick, but it's a game. And in all games, there's some certain tactics you need to use or should use in order to maximize the outcome. So if you want to sell your company or you want to raise money to your company, one thing is very important. Usually, it will not happen so often. Like if you have a great company, you are selling these products, you're expanding in the world, maybe if you're a super strong entrepreneur, you will do that maybe 2-3 times. But for most of us, that will happen just once. So it's important to really make the most of it. So you want to plan, prepare, and play. And I've met a lot of people that have sold their brand and then they get disappointed because they realize they could have got a much higher valuation. And obviously that in one way it affects their life, but mostly it also creates a bad feeling. Like you want to have gotten outmost. And the same is when you raise money. You don't want to think back, oh, in my seed round, I could have got double the amount. And then you feel this bitterness. You want to always be happy. Okay, so some advice. Think big and start out at 80%. I believe it's super important to have ambition. My experience is that all investors want to invest in ambition. So you want to have the highest possible ambition from the beginning. And when I say ambition, I mean in the plan you made, if it's raise money, it's all about how much money you need. If it's selling, you should have a high price. Because if you value your business on a high level, it's a much bigger possibility that others gets affected by that and believe that. And I would also say that it's a confidence boost, that you believe that the future is bright, and that's a great reason for them to believe it. Then start out at 80%, because you want people to feel that they're getting in a little bit, what we can call cheaper. Quantity is everything. If you're raising money or you're exiting, never go for first bid. You want to meet a lot of people. When we raised our Series A, I met with 68 VCs. There's the same with recruitment. If you get tired after the 5 first meetings and you just want to take the first one who's interested, you're doing it wrong. You want to meet a lot of people. Remember, this happens very seldom. It's not that you're going to do this every day. Timing is key. You do not decide beforehand, oh, I'm going to exit that day or I'm going to raise money that day. You have to raise money or exit when 2 things are right. 1, your numbers. 2, market conditions. So you don't want to do it when the market is falling or when you don't have the numbers. So that is key, because some people I know, they're like, oh, but I have money still on the bank account. I don't need to raise money. Yeah, that's maybe true. But if your numbers are right now are really good and the market is really good, you should go for it regardless. Why? Because you don't know what's going to happen in 6 months. Never lose momentum. When we had the 68 meetings, we had all of them in 3 weeks. It's important because you want everyone to feel that this is a fast process, and if they don't, work with your pace, they will lose out. If they come in a position where they decide on the timing, so they say like, oh, but we can't have a meeting tomorrow, we can have it in 2 weeks, then you are on the loser side. Never let that happen. 1 is enough, 2 is your show. Actually, this is an example from my wife's e-commerce. So she always says that, if you have an auction online and someone is, if you get only 1 bid on if you're selling something, that means that, either you're totally, have misread the market, or, a bad distribution. But usually it's a sign that you actually have put the price so high, so there's only one that will bid. I think it's important to think about that. It's not about getting, like in our case, 68 VCs to want to invest in us. It's about getting at least 1. And then if you have 2 or more, then it's your show, because then they need to show you why one of them should be the one who should invest. Have everything. With that, I mean have everything prepared in the sense of all documents, all the financial plans, your CAC, how the actual flow is, what is the checkouts, everything. You should have everything easy. And this is part of the first rule. It's all about visualization. If someone asks for something, you need to give it to them so they don't have to worry or think about it. Not too many details. Very simple. In everything you have, do not go too deep. It's, too many details usually only creates more, I would say, questions, but not good questions, but questions in the sense that they don't, it's detailed in a way which makes them, not understanding the high level. They're focusing on the wrong thing. And it's very important to keep things at the high level, because in the end, that's what it's all about. They will never have the ability to really understand your business. They have to believe in certain trends, certain structures you're giving them, and you as a person. Okay, people. Most businesses that are really successful, either in raising money or selling the business, is because they have great people in their organizations. So my first advice to everyone who have a great e-com and wants to either get more money so they can grow more or sell it, is to focus on hiring the best people, because that is always a safe sign that you are going somewhere. Great people doesn't come to businesses that are failing. Think in steps. Obviously, most important when it comes to raise. If you're raising money, you need to think of it not like one-time thing that will never happen again. You need to think about it as, in a startup, you have a seed raise, you have a Series A, you have a Series B, or a Series C. And this is very important, because then you're putting the right expectations on each phase, which also means that you can have a much more long-term perspective on what you're going to get out of it. And it's the most important thing here is that in the end, when you do the IPO, then everything is as you want it. Not that you get the highest valuation on the seed stage. When it comes to an exit, there's also stages. Usually you have an earnout, which means that you need to stay in the company for a certain time, and depending on the actual numbers, you'll get a multiple and a different pricing point. It's important that you think of it from the beginning. And then lastly, never break the rules. I usually am a little bit, confused when I see people do the opposite from a lot of this, and they don't have any real reason, just that they either are lazy or feel that they don't want to. And then afterwards, that is okay if you don't have any ambition, but afterwards they get really angry that when they realize someone else's were able to sell their company for much more or raise much more. If you want to have the best outcome, don't break the rules if you haven't thought it through very, very deep. Okay, this is my name. This is my phone number. Please don't call if it's not super important. But I'm happy to have questions on WhatsApp or otherwise. This is my mail, so samir@juni.co. And if you're not a customer, please sign up. We are open for all businesses in UK and EU. We love great e-commerce companies, and our only focus is e-commerce. So I'm 100% sure you will love our service and the features we're able to give you. Okay, thank you, everyone.
Samir, it's an absolute pleasure having you. I learned a lot. What you just gave us was a playbook for raising capital for e-commerce. This should be in the records and the books. We're going to sort of transcribe everything. People will put it in a Notion document, and you guys can get all the top tips, and you get the full transcription of this as well as the deck. Samir, you mentioned you guys spoke to 68 VCs in just two weeks. It must have been an incredible experience in sprints essentially over that period of time.
Yeah, so it was 3 weeks, but it was super, a lot, because we most of them we took more than one meeting with, and I think actually it's interesting because this is something that weren't possible in the same way before, because then people wanted you to meet them in person. But now with COVID, you can have 15 meetings scheduled.
Exactly.
Obviously it takes a toll on yourself having meetings from 8 a.m. to 10 p.m. in the evening, and the last meetings can be a little bit in quality. But I think it's super important. If you haven't met enough potential investors, and there's a lot of investors out there, it's very hard to know your own value, so what the market valuing you, but also come in a situation where you're in control. And I think for me that has been 100% obvious. And also when I see some of our customers, if they get a bid, because some of them are great brands, and these aggregators of e-commerces, but also VC sees that and contact them. If they just take the first one, that is it's like going in blind, because what happens is that you just trust that their bid was okay, and if you want to give a counter bid, you can't base that on anything really. What you need to do is to talk with 15 of them and understand, okay, is 8 of them interested? Okay, 8 is interested. Obviously, the first bid will not be the best. It's like an apartment.
Yeah.
So I think quantity is super important.
So e-com is certainly different from like tech, from fintech, tech.
Yeah.
What's your suggestion from all of the data and clients you've come across as Juni to raise capital? Would you say you want to, and it really depends on the ambition of the, let's say you want to create the next away, luggage brand, which is quite big, capital intensive. Would you just say you prove product market fit initially? And to what degree do you prove, product market fit? Is it just testing, or would you, hit a certain GMV and then get back to them and say, look, this is working. This is the total addressable, market size. This is the potential. Would you back us? When do you think time is important? What would you advise, the audience essentially on when to sort of trigger soliciting, whether it's angel or even VC money?
No, it's a great question. I think in today's environment, obviously it's not true for all products, but I would say 99%, you are expected to have launched. So you can't only talk about a plan that, I want to launch this great brand in this market segment and I need 5 million in order to do that. That would not be seen as reasonable, because people think that you should and can start up. So my main takeaway from the e-commerce is in early stage, and I think it's important to look at different stages here, but in the early stage, if you want to create the next away, what VCs will look at is, I would say, market opportunity is super big. So market opportunity, I would say, is the greatest differentiator and deciding point for an e-commerce. So where you are, in a Way's case, obviously, what's most important for investor is that, okay, regardless of how much, how good you are, can you actually, create 100x value on this in the travel accessories market? So that's one very important thing. The other thing is what I would call the way of distribution. So either you have, I would say, a great brand, and you can show that you are good at building that. And usually that has some certain parts attached to it, like you're focusing on one community, or you are really good at, building up what you can call like a brand promise. That is one way of doing it. The other way is that you have a framework on marketing. So I know, what we can call, e-commerces that has not maybe one brand. They may have 10 brands. But they're part of one group. But what they have, which is their super, strength, their competitive advantage, is that they have a framework on how to test, how to develop the products, and so on and so on. And that becomes something strong. So I think those two things are much more important than one number for GMV or so certain. Like I would say usually when you're looking at the number and not the trajectory, that's important maybe when you sell, like, oh, we want to buy an Amazon business with over 10 million in revenue because that says that you have come to a certain place and so on. But when it comes to raising, especially in the beginning, those market opportunity and, if you're great at building a brand or building a framework for your distribution, I think those are two important. And then, of course, coming back to the first point, which is the founder. So when you're raising capital, regardless if it's a tech startup or e-commerce startup, the persons, or person that does it, that is, 50%. And you need to be able to show that you can actually do this and that you're committed to it. So I think that is also super important. But if you have one, if someone here has a question about it, just contact me. It's so, it's, a lot of it is case by case, deck by deck. But I think these are, the main takeaways.
So we're incredibly thankful for you dropping your number. Nobody does that. Final question is, what's your expectations for this holiday season, BFCM? This is the theme of the conference. What are you seeing in Juni? What kind of data did you see last year? And what kind of expectations do you have? And how are people sort of prepping from a financial standpoint for this big event?
Yeah, great question. We have asked our customers over, all, I would say an overall majority. For them, Q4 is the biggest. Like, that's super big, and we expect the spend and growth to be, go up, and that will be the majority. What we see, however, and I just want to add this, is that the cost of acquisition has gone up on Facebook. So it's been a lot higher this year, and especially the last months, than it was before. So it will be interesting to see how that affects the Q4. I have a hard time seeing that Facebook will let that keep going, because they in the end will lose out if advertisers can't make money.
Pull out, exactly.
Yeah, but that will still be something interesting to see, because the cost of advertising has really gone up. So especially e-commerces that have products that is not that expensive have a hard time getting profitability. However, coming back to your last part with the financing, we are now in October launching our credit option. So we plan to fully be able to support all our customers to get the best credit we can give them in order to really propel their growth. So that is something we are doing together with all other things we're helping a customer with. But hopefully that will make them able to actually invest in all the campaigns, not feeling that they're losing out, leaving money on the table because they don't have the money to invest in the growth.
Yeah. Credit line is so important. We had Matt Putra talk about just securing credit as a backup right now, just due to the volatilities and unpredictability in the market, essentially from a supply chain and also an acquisition standpoint. So we could go on and on and on, but we'll let the conference go. Incredibly grateful. Thank you so much for coming on. Brilliant stuff. Cheers.
Thank you so much.